The recently released Paradise Papers have again turned the media spotlight on small tax havens. The only difference from last year's Panama Papers is that the contracts leaked to the public are from a respectable law firm in Bermuda, Appleby, and not from a suspicious and less-known firm in Panama, Mossack Fonseca. Otherwise, the key message is the same: individuals and firms use the services of tax havens to avoid paying taxes in their own countries. Appleby's media response was swift and clear: there is nothing illegal in their actions. In short, Appleby uses tax law loopholes that allow individuals and firms to transfer their wealth in countries where taxation is zero. The immediate reaction by some was that we should regulate and close these loopholes. That is the traditional regulatory way of dealing with distortions. Economists, however, tend to believe in the power of incentives and the invisible hand of markets. Closing down existent tax havens and loopholes will only open new ones somewhere else in the system. As long as there is demand for such services, the supply of these services will take place. Cracking down on small islands that offer tax services may even have unwanted side effects. Why? Let us explain. One argument gaining credence is that the existence of small island tax havens makes it less attractive for larger countries to engage in tax competition. The widespread use of tax havens alleviates what would otherwise be aggressive competition between big countries to reduce taxes as a way of attracting and maintaining real investment. Such real investments matter for big countries as, for example, they create jobs where people live. When firms are able to shift their profits to low-tax jurisdictions through financial transactions, for example, thin capitalization, the location choices for real investments become less responsive to tax rate differentials. Such arguments are part of a new literature on tax havens that tries to make sense of the empirical data that show the high demand by global firms for tax haven services. The above issues arise only because profits are taxed in the country where they are reported, but not necessarily generated. Reporting high profits in, say, the Bermuda subsidiary of a multinational firm and low profits in, say, the Australian headquarters is legal as long as the methods used to shift profits are following the rules that each country has. Here is where the Big Four accounting firms have their expertise in advising global firms. This separate accounting method of taxing firms is the basis of our current international taxing system. It was agreed back in 1926 under the auspices of the League of Nations and, almost 100 years later, nothing has changed, despite globalization. Any viable solution to the broader issues around profit shifting, and thereby tax havens, will need to focus on taxing profits in the country where they are actually generated. This calls for activity-based taxation for firms. To grasp the difference between income-based and activity-based taxation, think about consumption taxes, such as Australia's GST. They tax the goods that you buy and not the income that you have for buying these goods. The logic behind this is that income is fungible, whereas consumption is tangible.